Right now, many fixed investments are paying 4%, 5%, or even higher. And when you compare that to what you're supposed to get from stocks, which is a premium, a risk premium, it's called, you're barely getting more of an additional reward on top of that fixed rate that you can get elsewhere. The gap between what stocks are paying and what they're expected to deliver compared to a safe investment, like a fixed income portfolio, that gap, that difference, that premium has nearly vanished. And once you add fees on top of a managed portfolio, the question becomes, are the ups and downs of the stock market, are they really meaningful enough to make it worth it? Speaking of not being meaningful enough, let me bring in my co-host, Tony. Welcome to the show, Tony.
Super hurtful. Super hurtful, Dan.
I'm going to share a little my screen today. I'm going to share a little bit of technical wisdom on the stock market and how things are measured. But the general question is the stock market meaningful enough? Are the returns, I should say, meaningful enough compared to what you can get from the fixed income arena?
I wonder that myself sometimes. I mean, you see the charts of the last 100 years and, stocks have ticked up. But then you see years like 2022 where it's way down. And if you're in retirement, that's tough. So fixed indexed products and fixed interest rates on certain strategies are appealing. That's for sure. To somebody who's risk averse like myself.
But this is something that not a lot of people know is stocks are risky, bonds are supposed to be safe. And one of the common ways that analysts measure this scenario is comparing the S&P's earnings yield. Technical terms, earnings yield. Basically, how much profit a company has is generating relative to their stock prices. That's an earnings yield. You've heard terms like PE ratio, price to earnings ratio, so forth. Basically, in a nutshell, you say, if that stock company, if I own that company X, because that's what you do. When you buy a stock, you own a company. If company X is making $10 and there's 10 shares outstanding, that's $1 a share. You kind of get a feel for how much this earnings ratio is, how much they're earning relative to how much it's costing me. So this measure of what the S&P is providing as an earning yield, and you compare that to the 10-year Treasury note, which many consider risk-free, you get this difference, right? And generally speaking, the stocks are supposed to earn and yield a whole lot more than the Treasuries. That's just the way it works. But when you subtract what the stocks are yielding versus what the Treasury yield is yielding, you get a rough estimate, that difference of whether or not stocks are worth it. And what's happened in recent months and past year, is the gap has narrowed dramatically. And I want to show you this because it's starting to question whether it even makes sense to own stocks.
Well,
that's what this. I made
that's
this
a hot take, Dan.
Well, it's an age-old question. Why am I on this roller coaster? Right? Why should I take it? We've done shows on fixed rates before. We've CDs, fixed annuities, treasuries, I-bonds. And a lot of these are paying over 5%. So is it worth it to jump into stocks? And what's happening is, well, I want to show you a chart, and you can go and look at this yourselves. So this is the earnings yield gap, currentmarketvaluation.com. You can go and look at this model. I'm going to scroll down, Tony, to some charts because I know you don't like reading. We'll look at charts. Can you see this chart, Tony?
Yes, and I do love reading, though, Dan.
Oh, so the orange line is the S&P 500, and the gray line is the Treasury, 10-year Treasury rate. So you can see the orange line is higher here, but all of a sudden, they're pretty close to each other. I want to look at it in another way. This chart's pretty cool. It's kind of backwards. So if you look, and I'm sorry to the listeners on Spotify, but you can go to YouTube and watch this video and you'll see this chart. And you can go to currentmarketvaluation.com and see this yourself. It's showing historical since 1960 all the way to today. This chart shows a line in the middle, which is zero, meaning stocks and bonds are equaling in yield. The Treasury yield and the stock S&P 500 equal, parity. So you're not, doesn't make difference if you're investing in stocks or bonds. In this scenario, you're getting about the same. Historically, let's go to recent history. You could see when bonds, which is when it's high here, this chart is high, bonds are a better value than stocks. Stocks are overvalued compared to buying a bond. Look, in 2009, Tony, you would have been better off in bonds. Does that make sense? What was happening around that time with stocks? 2008, 2009.
Sure, the Great Recession, they called it.
Yeah.
Stocks tanked like 40,
Right.
50% in 2008. The housing bubble crashed and burst. And so bonds went way up. But look at the next 10 years. Ouch.
Yeah. Right. So bond yields were 3% roughly, earning more than the stock yields at that time. And then when the stock market crashed, all of a sudden, the perceived value, meaning, hey, I can buy this stock cheap. It's still going to have earnings. Apple's still going to sell those iPhones. Yet I'm buying the stock so much cheaper, I'm getting more value for my dollar. And if you look here in 2011, 2012, the yield was 6% in favor of stocks versus bonds, meaning you're getting an additional 6% by buying stocks in general. Now, this is the S&P 500, so it's 500 stocks. It's not picking exact winners and losers. It's picking a general assumption, which represents about 75% of the market in general.
Yeah.
So 2011, yeah, hey, it makes sense to buy stocks. And that's been the case. There's been a positive correlation to buying stocks versus bonds since 2010, 11, 12, 20, 22, 24, 25. And then look at the chart, Tony, here. The difference. Now, all of a sudden, it actually shows that bonds are yielding a higher return than stocks in general as of now. And the last time we were at this point was 2004, 2003.
Yeah.
Besides that dip in the Great Recession.
Sure.
So yeah, what you're looking at, here's another chart, another way to look at it.
And
this zero line
this is as of the end of March, right?
Mm-hmm, yeah. March 2026.
Yeah.
So that line of parity kind of crossed here earlier in the year at the end of 2025. So, sometime in 2025, it's not dramatically like, oh my gosh, get out of stocks. Bonds are better, but it's no longer, hey, do I buy stocks? Mm-hmm. Of course, no, that's not the answer. Not necessarily. And that kind of makes sense if you think about, Tony, the conversations we've had, and especially for someone like yourself who's risk averse, you're starting to say, is buying stocks right now worth it? When I can lock in a high yield of 4% on the Treasury or 5.5%, 6% on a fixed rate CD annuity. Really interesting dilemma we're facing. And this current market valuation earnings yield gap, as we call it, is kind of flipping the narrative lately. And I think you're going to see a lot of that discussion starting to happen again. What was the term Alan Greenspan used years ago? The stock market's getting frothy.
Did he say that? Greenspan was great. Do you miss Alan Greenspan as much as I do? Am I dating myself? But I loved Alan Greenspan.
Don't make me bring Ronald Reagan in for a third show in a row. I'm not going to do it. If we're going to go back, we're going back further.
Sure.
So, but let's be real, Tony. The stock market over the past 5 years, I don't even know how you would describe it. Unreal. I mean, it's performed tremendously well, much, much better than fixed income.
Oh,
Much better
yeah.
than bonds and CDs and annuities and bond ladder.
Record highs year after year for the last 3 years.
2026, we're still going up. So, Dan, what are you trying to tell me? We're going to collapse? See, this signal that we're looking at and that I showed in this chart, that's forward looking. It suggests going forward that the extra return for owning stocks going forward may be thinner than what we're used to. So, what does that mean for someone's retirement plan, you ask? Well, you didn't ask, but I'm
Diversify.
asking for you. Yeah. You need to start looking at the growth mix. You got to look at stability versus growth. And when the extra return for owning a stock gets smaller, and protecting the principal and having reliable income, fixed income, becomes even more important. And you might say, well, in the long run, right? Everyone always says in the long run, stocks way outperform. And I agree with that. And we've done shows on rising glide paths. We've done shows on how stocks are the way to combat inflation. But for a retiree looking at the going forward, saying, they need to start asking, why am I in the market? They need to look at their buckets again. Remember, we've done shows on the buckets. How much do you have in that fixed income bucket? Cash, short-term bonds, CDs, fixed annuities. You need to look at how much you have in there, because if we do have a drop, which the stock market does, where are you going to go for that money? You need to go where the stock market drop isn't going to hurt you, and that's the fixed income side. Your longer term bucket, yeah. I'm not trying to pick a top here. I'm not trying to pick a bottom, but you stuff you don't need to depend on every day. It can stay in the market, but stuff that you're going to be using in the near term, like it's getting harder and harder to justify having stocks for that purpose. It really is.
Yeah, because it depends on when you need it. I mean, if you need to take a significant amount out yearly and it's in the stock market, that's pretty rough. You have to be well diversified, and not just within your stock portfolios, but outside of stocks. Bonds used to be the safe bet. And then, they have 10-year periods where they're way down like we experienced. So now people are wary of bonds, but it does pay to be diversified, right? Just as of March, as of the last check from that chart, you can see bonds outperform stocks. So it happens, but there are other fixed opportunities outside of stocks and bonds where you can get principal protection, but then you're giving up some of the growth. So it's hard for people, I know.
It is hard. I want to bring up another aspect of this that is often not discussed, especially when you're talking with advisors, is the fees associated with it. Like if you buy a CD at a bank, or you buy a Treasury, or you buy a fixed annuity, there's no fee on those. So not only are you getting that fixed rate that you're also not paying a management fee to your advisor to control that, because, well, you shouldn't be anyway. If I'm managing someone's account and I throw the money in a CD for 3 years or 2 years or whatever, I'm not charging a fee on that, and I shouldn't be. So, but think about that. Now, not only all the stocks have to overcome the fixed rate, so let's say it's 5%. Not only does the stock portfolio that I'm managing have to overcome that 5%, it's got to overcome the blanket fee on top, which is usually about 1%. So now I have to get 6% just to break even with the CD. And what's the average return in the market? 8. So is it worth going for 8 when I can lose 8? You can lose 20. I don't know, Tony. I'm not. I know it sounds like I'm talking out both sides of my mouth here. I'm not telling people to abandon stocks. They've historically been the way to go, and over a long time, yes. But the question becomes, how much do I actually need right now? How much steady income do I need? And how much should I be allocating toward the fixed side now, because this risk premium has shrunk to almost zero? And it's like, well, now balancing is even more important, and looking at what you're going to need is really more important. So that's the message, Tony. The message is, review your allocation and make sure that you're not, because if you think about what's happened in the last 5 years, the stock market's gone up. Your portfolio has probably gone up. So in a percentage wise, you probably have more in the stock market than you did 5 years ago relative to your fixed income bucket, especially if you're spending that. So it may be time for a rebalance right now. And the best time to rebalance was when there's parity between the stocks and the bonds in terms of yield.
Interesting. It means what all this means is you have to have a strategy, and you can't put all your eggs in one basket, not to oversimplify. But it is good to take a fresh look at bonds, because I think looking forward, you're right. You can see some trends, and you can see where, hey, bonds can outperform stocks, and make sure that you have alternatives to just high risk stocks, right?
Yes. And always, again, rebalance. Look at what's happened historically the past 5 years may have put you out of whack through no fault of your own, just growth, tremendous growth. You have a 20% return year over year. It's going to throw your portfolio out of balance and this is why you should be rebalancing. Now, here's one last question I would also strongly recommend that people ask themselves, or more importantly, if they have an advisor, ask their advisor. And that's this, Tony. Are my stock positions worth the risk anymore? And hear what they have to say. And if you're making your own decision, reflect on that. Is it worth it? Is it worth it? If I wasn't in the stock market right now, if I just inherited $100,000 or won the lotto, whatever it is, and I have it, would I put it in the market right now? Or would I put it in bonds right now? Approach it that way and ask your advisor, okay, advisor, I have this much in the market. Is it worth it anymore? Because the dynamics have changed. The future expected returns relative to the returns of fixed income has changed. They're much more closer to parity than they've been in the past 10 years. So the question becomes, is my stock portfolio worth it anymore? And listen to what your advisor says. And if you're not getting an answer, if it's like, oh yeah, stocks are always good, well, we're fine. No, the rules have changed a little bit. It's time to really have a serious discussion about it. That's what I'm recommending people do. Have a discussion.
Yeah, rebalance. You have to rebalance once in a while. You have to look at it once in a while. It's not just set it and forget it. A lot of times, yes, stock market over time performs, but you have to look at your situation. Things change, right?
Yeah. And I'm not trying to time the market. Please don't get me wrong. We're not a market timing company. We're
No.
balance, we're allocation, we're being smart, we're focused on income. And retirees in particular really need to focus on income. The rest, they can invest. But when times like this, when we have such a rapid change between what stocks are offering relative to bonds now, it's time to relook, time to rethink. That's all I'm saying. So, Tony, what are you going to do? You're going to go ask your advisor, is my stock position worth it? See what they say. And I'm offering that same guidance to you, listener. Talk to someone, ask it. You might be surprised at what you hear. Thanks for another good show, Tony. We'll catch everyone next week.